FIIs have been selling Indian stocks consistently almost every single month, and yet the market has held up. Why? Because someone else has been buying quietly, steadily, without making any noise. Domestic institutional investors, or DIIs, basically the mutual funds, insurance companies and pension funds that manage our money, have been steadily absorbing that supply. And not just buying randomly, they have been increasing their stake quarter after quarter in specific companies. So we asked a simple question: where exactly is this smart domestic money going? And after digging through the data, we found 10 stocks where DIIs have been aggressively increasing exposure. Hi, I'm Aparna, and in today's video, we will be breaking down these 10 stocks one by one, what these companies actually do, what DIIs might be seeing, what the opportunities, and most importantly, what risks investors should not ignore. So stay with me till the end. Some of these names may genuinely surprise you. Let's start with stock number 1, which is Ujjivan Small Finance Bank. Now, the name might not excite you immediately, but here's what's actually happening here. DIIs have gone from holding just 8.5% in March 25 to over 31% by March 2026. That's almost a 4 times jump in stake in just 1 year. So what are they seeing? Ujjivan started as a microfinance lender back in 2005, gave tiny loans to people banks usually ignored. Over time, it evolved. Got a small finance bank license, built branches, went deeper into rural and semi-urban India. Today, it has over 700 branches over 26 states. The stock trades around 53 rupees and has a market cap of roughly 10,300 crore. But the real story is the transition happening inside the bank. Ujjivan used to depend heavily on unsecured microfinance loans, which is risky. So management made a call to diversify and build a secured loan book, and it's working. The overall loan book grew 27% this year to nearly 40,655 crore rupees. But the interesting part is secured loans grew even faster at 44%. Affordable housing loans grew 35%, MSME loans grew 58%, and gold loans almost tripled. Even newer areas like vehicle finance and agriculture banking are starting to scale. The bank is essentially rebuilding itself from the inside, and the balance sheet is holding up well. Asset quality has also improved. In fact, management has guided 25% advances growth in FY27, with credit costs moderating and return on assets normalizing towards 1.6%. Now let's look at the risks. Even after all this diversification, unsecured microfinance still makes up more than half the loan book. So if there is any fresh stress in that segment, borrower distress, regulatory tightening, or local disruptions, earnings can take a hit. Okay, now let's move on to stock number 2, which is BSE. BSE today is much more than just an exchange. It is a financial market infrastructure platform. DII ownership in BSE went from 12.3% in March 25 to nearly 25% by March 2026. That's a doubling of stake in 1 year. So what changed? First, think about what BSE actually earns from today. Yes, there's a transaction revenue from equity trading, but alongside that, there's listing services, data licensing, co-location infrastructure, index licensing, treasury income, and the BSE Star MF platform, which, by the way, is one of the most important parts of India's mutual fund and SIP ecosystem. This diversification matters because exchange businesses with multiple revenue streams become structurally stronger over time. Now, here's what makes this really interesting. DIIs themselves invested a record 8.5 lakh crore in Indian markets during FY26. SIP inflows crossed 32,000 crore per month. BSE captures this directly. More SIPs, more retail investors entering the market, more mutual fund transactions, all of it flows through BSE's infrastructure. The platform literally benefits every time Indian households save and invest. On the derivative side, Sensex options scaled massively. Average daily premium turnover reached 19,500 crore in FY26 versus 9,000 last year. That's almost 118% growth. BSE is also expanding its derivative segment with new products like mid-cap contracts and Sensex Next 30 derivatives. Now, if we zoom in on the mutual fund infrastructure, BSE Star MF processed 84 crore transactions in FY26 and mutual fund revenues grew 24%. Management is now integrating India Post and launching Star NPS as well. Now, the financial results reflect all of this. Consolidated revenue crossed 5,148 crore. Net profits rose 88% year on year to nearly 2,500 crore. EBITDA margins expanded to 64% and BSE ranked number 1 globally in IPO listings during FY26 at 4,198 rupees per share and a market cap of around 1.7 lakh crore rupees with a PE of nearly 69 times. The market is already pricing in a lot. And the risks are also real here. A large part of incremental profitability depends on derivatives volumes continuing to grow. Any regulatory intervention in F&O, pricing changes or competition from NSE could impact revenues. And the business is inherently market linked. When volumes fall, revenue and operating leverage both get hit at the same time. Now let's move on to stock number 3, Jubilant FoodWorks. Yes, the Domino's company. But here's what most people miss. Jubilant isn't just Domino's anymore. It operates Popeyes, Hong's Kitchen, Coffee, and through DP Eurasia, Domino's across Turkey, Azerbaijan, and Georgia. It runs 3,636 stores globally. DII ownership went from 31% in March 25 to over 36% in March 2026, which is a steady build-up. The stock is priced around 436 rupees with a market cap of 28,700 crore and a PE near 69 times. So yes, growth expectations are baked in, but what's the core strength? Scale. Domino's India alone has 2,455 stores across 521 cities. That's one of the deepest food distribution networks in the country. The company also runs 25 plus food parks and centralized commissaries that manufacture dough, sauces, and ingredients at scale. This gives them advantages that smaller players simply cannot even match. In Q4 FY26, Domino's order volumes grew over 10% even though same-store sales growth was just 0.2%. What does that tell you? Growth is coming from store expansion and geographic reach, not just pricing. The market opportunity is large. India's organized QSR market is expected to grow to 51,678 crore by 2028, driven by rising incomes, digital ordering adoption, and younger consumers gravitating towards organized food brands. Internationally, DP Eurasia generated 2,400 crore in revenue during FY26 with 8.3% PAT margins, and Coffee has already become the 5th largest coffee chain by store count in Turkey. That's a genuinely underappreciated milestone. But yes, there are risks. Domino's still drives the bulk of profitability. Popeyes, Hong's Kitchen, and Coffee are scaling, but their long-term profitability is still being established. The business also carries high fixed costs, that's rent, delivery infrastructure, employees, which means weak same-store sales can pressure margins quickly. Jubilant's exit from Dunkin' in India is also worth noting, as it shows that scaling new formats in competitive segments isn't easy. Now let's move on to stock number 4, which is Equitas Small Finance Bank. Now it's a small finance bank focused on small businesses, used vehicle buyers, and affordable housing customers. This is a bank that went through significant stress, and DIIs kept buying through it. Ownership went from 42.7% in March 25 to 50.9% in March 26. Consistent quarterly build-up. The stock is trading around 66.5 rupees with a market cap of 7,583 crore, a relatively conservative valuation. So what are they tracking? Recovery. And it's showing up in the numbers. X-bucket collection efficiency, which basically measures how much of total dues, including overdue accounts, the bank collected, reached 99.71% in Q4 FY26, near 100%. That means borrowers are repaying and the stress phase is normalizing. Management confirmed that asset quality is stabilizing and the recovery is broad-based across segments, not isolated to one area. Even on the liabilities side, Equitas has been improving its deposit quality and pushing more customers towards deeper banking relationships and digital usage. And the results are already visible. Savings account costs fell from 5.94 to around 5.1% over the last 2 years. Overall funding costs also came down from 7.13 to around 6.94% in just 1 quarter. Even more importantly, the gap between Equitas interest rates and large private banks has narrowed sharply. And it matters because lower funding costs can improve margins and make the bank much more competitive over time. But yes, there are risks. Commercial vehicles, one of Equitas' key lending segments, remains sensitive to fuel price moves and any consumption slowdown. Borrower cash flows in that segment can weaken with a lag. Now let's move on to stock number 5, which is Voltamp Transformers. Founded in 1967, it makes oil-filled and dry-type transformers. I know this is not the most exciting introduction, but let me tell you why DIIs went from 23.5% ownership in March 25 to 31.6% in March 26. It comes down to three things: a sector tailwind, a disciplined company, and an incredibly strong balance sheet. The sector tailwind is massive. India has a 9.2 lakh crore transmission capex pipeline. Voltamp is perfectly positioned for this. And unlike EPC companies that depend on government ordering cycles, Voltamp has over 1,000 private sector customers. That means more predictable cash flows and less project execution risk. The numbers are clean. Revenue grew to around 2,100 crore in FY26. Operating margins are healthy at 16%. PAT was around 305 crore in FY26. The balance sheet is virtually debt-free with reserves crossing 1,780 crore and liquid investments of over 1,000 crore. ROC is nearly 28%, which is outstanding, especially for a company sitting on so much cash. Now let's look at the growth trigger. Voltamp is investing 200 crore to build a new plant at Jarod, Vadodara, which will add 6,000 MVA of power transformer capacity. Now this capex is fully funded from internal cash, so no debt needed. Now this will be operational around July 26 and will expand the company's capability into the higher capacity transformer category. This is where margins are better. But yes, there are risks too. Transformer manufacturing depends heavily on copper, grain-oriented electrical steel, and transformer oil. These are globally volatile commodities. And since many orders are fixed price contracts, sudden raw material spikes can squeeze margins before price revisions kick in. And rising competition is also a problem. Now let's move on to stock number 6, which is Eternal. This is Zomato's parent company, but calling it a food delivery company today is genuinely underselling it. Market cap of 2.35 lakh crore at 244 rupees per share. DIIs went from 23.47% to 35.88% during FY26. That's a 12 percentage point jump in 1 year. What are they seeing that we might not be seeing? It's the ecosystem. Eternal today operates food delivery, Blinkit, its quick commerce arm, Hyperpure, which supplies ingredients to restaurants, and District, which is its going out platform. Multiple businesses, each capturing different moments of consumer spending. The biggest trigger here is Blinkit. Management has guided for 60% plus annual growth over the next 3 years, with steady state EBITDA margin of 5 to 6%. Some regions are already operating around those levels. The target is to expand to 3,000 dark stores by March FY27. But here's the insight that most people missed in the quarterly call. While competitors have been pulling back on marketing spends, Blinkit is actually seeing lower customer acquisition costs despite maintaining its aggressive expansion. That kind of dynamic, if it sustains, creates long-term market share advantages that are very difficult to reverse. Hyperpure has also turned profitable and is expected to contribute meaningfully to long-term earnings. District is expanding across the going out category, movies, events, dining. Management's overall goal is to build a 9,600 crore EBITDA business by FY29 across all existing verticals combined. But yes, there are risks too. Gig worker regulation. Blinkit's economics depend on a large delivery partner network. Any future requirements around minimum compensation, insurance, or social security contributions would increase fulfillment costs across the industry. It wouldn't uniquely hurt Eternal, but it could slow down the margin expansion that investors are currently expecting from this space. Now let's move on to stock number 7, which is Dr. Reddy's Laboratories. It is one of India's largest pharmaceutical companies. Market cap of 1.09 lakh crore at around 1,310 rupees per share. DIIs went from 25.63 to 30.72% during FY26. And here's the thing, they are probably not buying it for the next quarter's earnings, they are buying it for what's being built. The pharmaceutical industry is changing. Traditional generic drugs remain large, but pricing pressure has made growth harder. The next frontier is biosimilars, peptides, and GLP-1 therapies, areas where competition is structurally lower and margins can hold up for longer. Dr. Reddy's has been quietly building in all these three areas. The most watched development right now is semaglutide, the active ingredient in weight loss and diabetes drugs that has taken the world by storm. Dr. Reddy's became the first company to receive approval for a generic semaglutide injection in Canada. It launched the product in India under the brand name Obeda. In fact, it also secured approval for semaglutide tablets in the domestic market. Now, these may not dramatically move revenues in the next few quarters, but being early in one of the fastest growing therapy categories globally is a strategic position that matters enormously over a 5 to 7 year horizon. Then their biosimilar has now entered regulatory review in the US. If approved, these products typically face less competition and hold pricing power for longer than regular generics. Now, the underlying business remains strong, excluding a one-time impact from inventory adjustments. Revenue grew 4.6% to 34,000 crore, with EBITDA margins at around 24.7%. India, Europe, and emerging markets all delivered double-digit growth, reducing dependence on any one single geography. But the risk here is execution. Semaglutide, biosimilars, and peptides are fundamentally more complex than traditional generics. They need higher manufacturing investment, regulatory expertise, and carry real commercial uncertainty. Okay, now let's move on to the next stock, which is Varun Beverages, which is PepsiCo's largest franchisee in India and one of the largest globally. The stock is trading at 540 rupees per share and a market cap of 1.82 lakh crore. DIIs went from 9.19% to 14.35% in FY26. Now here's how most people look at this company. It makes Pepsi and 7-Up, it fills bottles, it sells them. But here's how institutions are looking at it. It's one of the most sophisticated beverage distribution networks in Asia, operating across 10 countries and controlling more than 90% of PepsiCo's volumes in India. That's the reframe, and it matters because what institutions are really valuing is the distribution moat. A network built over 3 decades, covering retail outlets, cold chains, and logistics routes across India that would cost billions of dollars and years of time to replicate. Volume growth for CY26 was 16.3%. India grew 14.4% and international markets grew around 21%. Revenue grew 18% while EBITDA grew 21%, which tells you that scale is improving margins, not just revenue. For a beverage company, volumes is what really matters. Another factor institutions are likely tracking is the Africa strategy. The Twidza acquisition gives Varun manufacturing capacity and retail access in South Africa. And the Crickley Dairy acquisition broadens the product range beyond soft drinks, allowing the same distribution infrastructure to serve more categories. The risk here to watch closely is the Africa execution. Now let's move on to stock number 9 on our list, Tech Mahindra, which is one of India's largest IT service companies, serving 1,100 global clients across telecom, manufacturing, BFSI, retail, and healthcare. With around 1.4 lakh crore market cap, the stock is trading at 1,423 rupees. DII ownership went from 32.13% in FY25 to 37.34% in FY26, and this one is genuinely a turnaround story. In FY24, Tech Mahindra's operating margins had dropped to 9%. Operating profit was around 4,500 crore. The company was underperforming peers significantly. Fast forward 2 years and the margins are back at 16%. Operating profit has doubled to 9,000 crore, 10 consecutive quarters of margin expansion. EBIT margins went from nearly 6% at the start of the transformation to 13.8% in the latest quarter. That's not lucky, that's execution. And deal momentum supports this further. FY26 deal bookings grew 42% year-on-year to 36,000 rupees. This included multiple large transformation contracts and 2 consecutive mega deals. In IT services, large deal wins matter because they create revenue visibility and signal that clients are trusting the company with bigger portions of their technology budgets, not just small projects. Diversification is also improving. While telecom remains core, manufacturing, BFSI, and retail are all growing together. Now on AI, management believes that AI adoption will actually increase demand for enterprise modernization and legacy technology transformation rather than reducing IT spending. That's a counter narrative to the AI kills IT jobs fear, and it's the positioning Tech Mahindra is building its strategy around. But yes, risks are real too. If enterprises use AI primarily to reduce project sizes, automate developer workloads, and lower outsourcing costs, revenue growth across IT services could stay muted, even as margins improve. Tech Mahindra might keep expanding margins, but top-line growth could remain more challenging than the market currently expects. And now time for the last stock, Godrej Consumer Products. Think soaps, household insecticides, hair color, air fresheners, detergents. With a market cap of 1.05 lakh crore, the stock is trading around 1028 rupees per share. DII ownership went from 12.19% to 18% in FY26. India business delivered 8% underlying volume growth and 10% revenue growth in the latest period. And this growth wasn't from one category. Household insecticides, fabric care, and air fresheners all contributed, with home care actually outgrowing personal care. But the real insight is Fab, Godrej Consumer's fabric care brand. It's reached a 500 crore annualized sales run rate and hit break-even. On the surface, 500 crore for a 14,000 crore revenue company looks small, roughly 3% of the business, but detergents are one of India's largest household categories. Breaking even is the hardest part. Once you are there, even modest market share gains over time can be enormous. Indonesia, which had been weighing on investor sentiment for several quarters, has delivered 2 consecutive quarters of 4% volume growth. Management expects value growth to accelerate as pricing pressures ease. Even Africa, USA, and Middle East delivered 20% revenue growth despite increased advertising. That investment decision actually signals confidence, and management is choosing long-term market share over near-term margin protection. The risk here is commodity inflation. Crude-linked inputs and palm oil are volatile, and management has already signaled some margin pressure in the next couple of quarters. Now let's step back and look at the full picture. These are the 10 stocks that DIIs are steadily increasing their exposure in. Different sectors, different risk profiles, different timelines. But there is one common thread. All of these are businesses where earnings visibility is improving, whether through asset quality recovery, margin expansion, sector tailwinds, or new product cycles. Something is changing for the better. And here's what that means for you as an investor. You don't need to time the market perfectly, you don't need to predict the next move, but you need to know where steady, patient, well-researched money is building positions. Because that's usually where compounding quietly begins. Do you want us to cover this regularly? Let us know in the comments. And if you found this video helpful, do give it a like, share it with your investor friends, and do subscribe to the channel. See you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.